Imagine a beautiful concert hall filled with empty red seats, waiting for musicians who never arrived. That is how foreign investors have seen India's corporate bond market for many years. A place with great potential, but hardly anyone playing inside. In May 2025, India's regulators swung the doors open. The Reserve Bank of India removed short-term investment limits and relaxed rules for foreign investment in corporate bonds. The market regulator SEBI is also making it easier to complete KYC and access bonds. The message is clear: make doing business in India easier and welcome foreign money into a market that was previously hard to enter. This video will explain what these changes mean, why they matter for investors and India's economy, and how they connect to the global financial picture. Let us begin by understanding the basics. Think of India's corporate bond market as that concert hall. For years, it has been underused and limited. A few large companies dominate the stage. In the financial year 2024, 97 out of every 100 new bonds were issued by companies with top credit ratings. Also, most bonds were issued privately. Only 19,000 crore rupees worth of bonds were sold in the public market, while 8,38,000 crore rupees were issued in private deals. Because of this, India's corporate bond market is still very small compared to other countries. It is only about 18% of India's total economy. In comparison, China's corporate bond market is about 36% of its economy, and South Korea's is around 80%. By the end of 2024, India's total bond market was worth about $2.7 trillion US. Out of this, only about $602 billion came from corporate bonds. That means just about 1/5 of the total. Why does this matter? Because corporate bonds can help businesses raise money and grow. They reduce the pressure on banks and offer a cheaper way to borrow. In recent years, more companies are choosing bonds to raise money, showing a shift toward debt financing. But right now, only the biggest companies are allowed to perform on this stage. Foreign investors mostly stayed away. These new reforms aim to change that. In May 2025, the Reserve Bank of India removed two key restrictions. First, it took away the rule that foreign investors could only invest up to 30% of their portfolio in bonds with less than 1 year left. Second, it removed the rule that limited how much foreign investors could buy of any single bond. This gives foreign investors more freedom. Now they can buy and sell bonds without worrying about these limits. The central bank wants to send a message. If you want to invest in India, there should not be unnecessary regulatory problems. At the same time, SEBI is also acting. On May 13th, it proposed making KYC easier and expanding access to government and corporate bonds through the fully accessible route. This would help even small investors or individual foreigners buy Indian bonds. To understand this better, let us look at the three main paths available for foreign investors to enter India's bond market. First, the general route, which is the default but has limits on how much can be invested. Second, the voluntary retention route, where investors agree to hold bonds for at least 3 years and in return face fewer restrictions. Third, the fully accessible route, which started in 2020 to encourage investment in certain government bonds. Before the new reforms, foreign investors were using only about 15% of the limit allowed under the general route. In early May 2025, this number was still just 14.5%, slightly down from 15.7% a year earlier. The voluntary retention route is more popular, but these new changes mostly help the general route. If you are still watching, now would be a great time to like and subscribe to our channel. This helps us reach more people and bring you more easy to understand content like this. Moving back to our topic. So what does this mean for investors? Think of the stage finally being ready. The instruments are tuned, the lights are on, and the foreign investors, the orchestra, are finally allowed in. This can bring more money into India's corporate bonds. More buyers usually means bond prices go up and interest rates or yields go down. Some big companies are already using the bond market. Foreign demand could help make borrowing cheaper for them. For local investors, this is also good news. If more companies raise money from bonds, banks won't have to lend as much. That could help reduce interest rates or let banks focus elsewhere. For stock investors, it means companies can grow faster by raising money easily. But there are still some big roadblocks. First, the returns from India's bonds are not clearly better for foreign investors. For example, India's 10-year government bond gives a return of about 6.5%. But foreign investors often need to hedge or protect themselves from changes in the rupee's value. This hedging can cost more than 4%. After this cost, the extra returns over US government bonds are not very high. So the fully hedged returns in India are not attractive right now. In simple terms, the cost of protection and some taxes reduce the extra earnings from Indian bonds. One major issue is the high cost of swap fees used for hedging. Second, liquidity is a problem. Many corporate bonds do not trade much after they are issued. There is no strong secondary market. Big investors worry about how easily they can sell if needed. So far, only long-term investors like pension funds using the voluntary retention route are showing interest. SEBI has said it will work with investors to fix this problem. Over time, better trading platforms and market makers may help, but changes will be slow. These reforms are not just small changes, they are part of a larger plan. India wants to use its bond markets to fund the next phase of its growth. A stronger bond market will help raise money for infrastructure, promote the rupee as a global currency, and develop the gift city financial hub. A deeper corporate bond market would also ease the burden on banks. Right now, most borrowing is done through banks. If more companies borrow through bonds, risk is spread out. This also helps the government, which is aiming to keep its debt below 50% of GDP by 2031. More private borrowing through bonds means less pressure on public funds. For investors, this brings more choice. Bonds from top companies often give better returns than government bonds. If hedging becomes cheaper, foreign investors can earn better returns. It is a way to invest directly in India's growth story, instead of just lending to the government. More foreign investment can also make the rupee more stable. These flows can be unpredictable, but if managed well, they can add liquidity and help strengthen the currency. Now let us look at the bigger picture. India's government bonds are being added to global bond indexes in September 2025. This includes the FTSE Emerging Market Government Bond Index. This could bring tens of billions of dollars in investment from global funds. FTSE expects India will make up about 9.4% of the index once included. In fact, foreign investors have already started buying. Since late 2023, they bought over 1.2 trillion rupees worth of Indian bonds. At the same time, global interest rates are changing. After many rate hikes in the US, inflation has slowed and central banks have started cutting rates in 2024. India took advantage. With inflation around 3.6%, the Reserve Bank of India cut rates in February 2025. Bond yields in India are already falling. This makes India attractive. During the rate hikes in 2022 and 2023, India's bond yields did not rise as much as other emerging markets. If US interest rates remain stable or fall, India could attract more investment. Still, other factors matter too. Some investors will compare India with China and other countries, but India has some advantages, such as strong foreign exchange reserves and responsible fiscal policies. The plan to reduce debt to GDP over the next few years builds confidence. But challenges remain. Here are the key hurdles for foreign investors. First, currency hedging costs. Protecting against changes in the rupee can cost 3 to 4% and reduce returns. Second, low liquidity. Many bonds do not trade actively. This makes it hard to exit large positions. Third, complex tax rules. Foreign investors often pay more tax on interest income compared to Indian investors. This needs to be simplified. Fourth, credit quality. Right now, most bonds are from top-rated companies. If foreign money flows in, yields on those bonds could fall further. Smaller companies might still struggle to get funding without better risk structures. Fifth, global mood. Foreign investors are cautious. If US bond yields rise suddenly, or if there are geopolitical tensions, money can leave India quickly. This happened briefly in 2024. The regulators know these issues. SEBI and the central bank are talking to investors and adjusting rules. For example, the voluntary retention route limit was increased from 1,75,000 crore rupees to 2,05,000 crore rupees for the financial year 2024 to 2025. The plan is to open up step by step. So what are the key takeaways? First, the message from India is clear. Foreign investors are now welcome in the corporate bond market. Second, we are still in the early days. Despite the new rules, foreign investor usage of the bond market is still low. Big hurdles like high hedging costs and low liquidity will slow the inflows. Third, more foreign money could lower borrowing costs for companies, support growth, and reduce pressure on banks and government funding. Fourth, global developments matter. India's addition to global indexes, a stable currency, and falling inflation all help attract money. But foreign investors will always compare India with other markets. Finally, the big questions remain. Will foreign inflows pick up if hedging becomes cheaper or if global rates fall? Will bond yields drop more? And will smaller companies finally get a chance to raise money through bonds? Thank you for watching this breakdown of India's corporate bond reforms. If you found this helpful, please subscribe to our channel. Share this video with anyone who wants to understand India's bond market better. And remember, we are here to make finance simple for you.